Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing our weekly recap for December 17th through the 21st, 2018. We're going to be going over the four main indexes, the emerging markets, stock futures, after hours, what companies have moved up or down the most. Take a look at the S&P 500 as a whole for the day and the week. Go over the financials. They sold off hard this week. I believe they sold off for 5%, somewhere in that range. We'll take a look at home builders, oil, dollar, silver, gold, bonds, and we'll wrap it up by taking a look at the M1 Finance portfolio. I do want to make a whole video going over my plan, what my goals are for 2019. So that is something I'm going to be releasing next week. So if you are brand new to the channel, hit that subscribe button below. If you are a recurring viewer, have not yet subscribed, hit it as well. Hit that subscribe. I'm trying to hit 2,000 subscribers by the end of 2018. It was my goal to hit 1,500, but I want to go ahead and just say 2,000 right now. Let's go ahead and hit 2,000 by the end of 2019. And if you do like the video, hit that thumbs up button below. And if you have any comments over the question, have a question over stock market, personal finance, real estate, let me know in the comment section below. I always read and reply to them all. So let's go ahead and get into it. Last week's changes: the S&P Dow Jones fell over 8% there. The Nasdaq and the emerging markets were down 0.84 and 0.08. My portfolio sold off last week down 0.62. The Russell 2000 had continued growing concerns. Now, I posted a couple weeks ago suspicious that the Russell 2000 was losing 2%, 2%, 2%. Now we have some growing concerns, and guess what happened this week? If you look at the Russell 2000 for the 5-day change, we are down nearly 8.5%. We're down 8.42% within the last 5 days, down 15.85% year to date. That is a huge loss. So the off our highs of the Russell 2000, we're now in a bear market. So here, if we look back at just the last 3 months, we've sold off over almost 25% of the equity here within the Russell 2000. So this is one that sort of used as an indicator of the economy. This is why there's growing concerns of a slowdown in the economy, because the Russell 2000 is a lot of these small mid-cap stocks. 1-800-Flowers, and some, that's the only one that I know. It's right down the street from where I work. But just continuing, no longer growing concerns. Now we're just straight concerns. So let's go ahead and continue there. I did create an article over on my website going over a beginner's guide to using M1 Finance. I really enjoy M1 Finance. I believe it's a great platform, and I just released a new one today going over what does M1 Finance do with your dividends. Does it drip it? Does it flip it? So both of these articles are available over my website, and also here on my Facebook. I do have links over there, but the description below will have links to my website where you can access those for free. Those are just an Instagram post from last week. I'll have to do one for this week as well. Johnson & Johnson sold off 10% last Friday, continued to sell off nearly 3% on Monday. Stock futures were looking positive going into Monday. I didn't expect much this week. I expected there to possibly be a little bit of green here in the market, but once the Fed came out, I expected the market to really sell off. They were going to be raising rates by 0.25. That's a loss of buying power by 5%. So I expected the markets to fall at least 5%. And if they continue to raise rates in 2019, as they're expecting to raise them 2 more times, 0.25 each time, we may lose 10% more in the stock market and just 10% as far as buying power goes. So we shall see how that kind of plays out. If you look at the rates as overall, over the last year, they've raised rates by 1.5%. That's a loss of buying power by 30%. And the stock market has fallen, off their highs here by 30%. So that could be a little indicator there. Anyways, kind of continuing on, Johnson & Johnson plans to buy back $5 billion of their stake. So here on Monday, the support has broke. We broke through the support line of the index there. The bulls are losing control. And then the rate hike on Wednesday will send us down further. So a little bit of, we've already kind of passed the concerns. There were growing concerns that we had a slowdown in the economy over the last few weeks. People were losing, I can't think of the word. They're no longer as hiked up as they were. They're just kind of not there. So Robinhood, they rebranded their checking and savings to Cash Manager because it's going to be held inside of their broker. So there was outcry there over the checking accounts. I did release my article, stocks to buy going ex-dividend, or just stocks to check out going ex-dividend next week, December 24th through the 28th. The winners this week were Bank First Corp, Portland General Electric, Altria. Altria was a very popular one this week over in the Facebook groups. Everyone is buying this one up. They recently did a huge dividend increase. They have a starting yield of over 6%. They have strong financials. They're getting into the marijuana industry, and they just put in $13 billion into Juul. So we also have Regal, Belliot, and Thor Industries there. There's my article, stocks going ex-dividend next week. It is available on my website and here on the Facebook page. I have some 300 followers almost on Facebook, so if you aren't following me on Facebook, the description is below. Start following me. I put out content just about every day, if not, every few days. So interesting article going over stocks, the biggest stocks that are currently in a bear market. So here, Netflix, Facebook, Citigroup, AbbVie, IBM, Apple, all these big name companies are in a bear market, meaning that we've lost 20% within the last 3 months. Over 20% loss there. So here, Wednesday, I came out with some little articles I found out there. Altria put in a stake in Juul with that smokeless, the little USB looking things. ABM, this is a new stock I added to my portfolio recently. They beat estimates, they beat earnings. They jumped up over 18% in a week time span. So I actually made a video where they were up over 22% within my portfolio. I went ahead and sold my gains. I sold some of the gains that I had made in that short amount of time and had moved those gains into another company that had actually lost 5% of the equity since I had invested. So I just kind of took gains and moved those gains, kind of reducing risk out of there, and moved it into a stock that had already been hammered, increasing my dividends and decreasing my unit cost for my other stocks. So I'll put out that video here on Sunday. General Mills came out. They beat earnings. They didn't hit revenue expectations, but that's completely fine. They still increased their revenue year over year. So interesting articles there. Fed came out. They were live. I posted that over on Facebook. Watched them while they were kind of talking. And initially, when they raised the rates, the stock market actually bounced higher. But Chairman Powell came out, started discussing the market. Wasn't very optimistic kind of going forward. Really sold off on Wednesday. Friday, the president came out. President of the Fed chairman. I can't think of his name. I'm not going to go ahead and just butcher and just random out name. But he came out trying to put a bottoming out point on the market, just completing, bleeding out. He put out they plan to raise rates only 2 times in 2019. They put out that they are looking at the stock market and the economy, taking that into account, but it didn't help. The stock market continued to bleed off there. Apple is down huge on Wednesday and Friday, down almost 7% there together on the day. Worst performing stocks after the Fed wrecks the market. So that was an article I kind of posted out there. I thought that was fun. And I think that's just about it. My Roth 401k is wrapping up for the year. So I've actually made more money out of my Roth 401k than I did anywhere else. So my company contributes, it does a match of 5%. So this is the first year being involved in it. And every quarter, I make a little over $23 now in dividends just off my Roth 401k. So I think that's very exciting kind of going forward, that it may be, first year being with my Roth 401k, but it's paying me out $23 every quarter, which is 23 by 4 is $96 every year of just straight dividends. Plus I'm getting free money for just investing in that anyway. So great time to be doing that. That is all there. So let's go ahead and jump over to the markets. The S&P 500, not quite in a bear market right now. That would be a loss of over 20% within the last 3 months off their highs. Currently, 5-day change down 7.05%. Year to date, down 9.61%. The Dow Jones right now, 5-day change down 6.87%. Year to date, 9.2%. The NASDAQ here, 5-day change down 8.36%. Year to date, down 8.26%. So last 3 months, the markets have really sold off as of October. So currently, the S&P down 17.51. The Dow Jones down 16.07. And the Nasdaq. There was an article today that the Nasdaq is now in bear territory. That is now considered a bear market within the Nasdaq, having fallen down over 20% off their highs within the last 3 months. The Russell 2000, that small and mid cap, is also fallen down more than 20% within the last 3 months. So the Nasdaq and the Russell 2000 are now in bear territory. Over the last 5 days, the Russell 2000 is down 8.42%. So it's no longer suspicious. It's no longer a growing concern that the economy is slowing down. This is just down 8.42%, and just within the last 5 days. This is just sort of a bleed out. Somebody just kind of gouged it. It's hemorrhaging. We got to slap this thing with a band-aid, but it's not going to work. It's just, tourniquet. We got to put a tourniquet on it. That always helps. So emerging markets down 3.29%, year to date down 18.25. Stock futures are currently looking positive, but we shall see how that plays out. I still plan on putting $330 for the next 2 weeks going into the market. And then in 2019, the first day, I'm going to be transitioning that a little bit because the cap has increased from 5,500 to 6,000. So I'm going to continue to invest my Roth 401k. My wife's going to continue to invest in her 403b, and we're still going to be maxing out her Roth IRA for 2019. So those are some other little plans. Currently, after hours, we had a couple of stocks here. So Zillow, Under Armour, Chesapeake Energy, those are some of the names here that I recognize. Hanes Brands there. So some companies here continue to do positive here in the after hours. Now, some of the companies here that did fall, there's quite a bit of stocks here that are very popular here that are continuing to fall. Cisco, Bank of America, Microsoft, Exxon, Micron, Apple, AMD, General Electric. Pfizer popping up positive. That's a nice little one. Facebook there down 0.36%. Facebook just can't catch a break. People are saying, hey, Facebook's going to be bottoming out here at 130. This thing is down to $124.50. Even Apple. I bought Apple at 164, rode it all the way up to 233. I made a video several months ago saying, you know what, I'm going to sell at 228. Guess what happened? It went over 228. I never sold it off, and now I've lost all my gains. I've still made $100 in dividends for 2018 from Apple, but I'm currently down in the position, so I'm just going to hold on to it. I'm not worried about it. Apple will, recover here with time, but for the most part, it's just kind of, I know a lot of people get kind of sick to their stomachs if they look at their portfolio. I'm like, oh my goodness, I lost so much equity, but you've never really lost. Well, technically, yes, you do lose the equity right there. You've lost it. It's not there right now, but you don't capture that loss until you actually sell those positions. So I'm still getting dividends, and in the future, Apple is continuing to build up their services. So I do see them turning around. Once this whole thing with the market, it's not just Apple that's falling. It's Amazon losing 6%. It's Google going down 3%. Microsoft, they were sort of the FANG that didn't quite get hammered. Even they're selling off now. So here, normally when we look at the market for a day, normally there's specific sectors such as utilities and healthcare that are actually either flat or slightly green. Here, Friday, huge sell-off. Nothing was safe unless you put out some sort of earnings. So earnings here, Nike put out some very strong earnings, up 7.17%. Not sure. CarMax here, they must have released some good earnings. They're up 3.95%. Now, if we take a look at the 1 week performance, here we go. I don't know if I can zoom in just a little bit more. Yeah, it doesn't zoom in though. It doesn't zoom in well. So here, Apple down 8.91%. Amazon down 13.47%. Google nearly 6%. Microsoft, oh my goodness, 7.3%. Exxon nearly 10%. So look at this. Lots of red out there. Are there any safe areas in the market? No. Look at this. General Mills, there's that one I've been buying up 3.83%. So that is one there. So that's a fun little one. So I don't need to go over single stocks here. This kind of shows us everything. We don't have to look at specific stocks any longer. We'll look at Finviz here for the last day of the week, and then overall for the market here as far as the week goes. This is a very nice visual view of even Berkshire Hathaway is out there losing 4%. So you're not really safe anywhere. It's not that specific stocks are tanking, it's the entire market. So feel better that it's not the stocks that you've specifically picked, it's just the market as a whole. So financials sold off the most that I've seen here in quite a while, down 6% for the week. If we take a look over the last 3 months, it is now in bear territory, falling down 20.7%. Year to date, down 18.34. Home builders as well, down 5.13. Year to date, down 28.97 within the last 3 months, down 21.22%. Also bear territory as well. So I had kind of discussed why has oil been dropping. It's been oversupply right now. We have an oversupply, not enough demand. There's a growing concern of the economy. We saw the Russell 2000 falling off a cliff there. So they have some huge concerns over the economies. China's already been in a bear market. We are kind of moving into a bear market. 40 to 60% of the stocks within the S&P 500 are already trading down in bear territory. And this is it's going to get worse. And it's going to get, I think it's fine. This is what I've been planning for. 2017, I transitioned my portfolio from a growth investor to a dividend, defensive position. I used to own so many stocks. I used to own Tesla. I used to own Amazon. I had a 100% run up on Amazon between 2014 and 2017 when I sold Amazon. I bought Amazon at $450 back in 2015 or 2014. One of those years. I know I owned Amazon. I took it from 450 all the way to 900. Doubled my money there. I owned Weight Watchers, Tesla, Altria, not Altria, Activision Blizzard. What was the other one? I had PayPal, Visa. I own a number of growth stocks that were just, huge gains, double back, 10 baggers back in the past. But I wanted to move my portfolio to become more defensive. We had been in a huge run up, and that's why I kind of transitioned my portfolio. Back when I started this channel, I started my Robinhood portfolio and was starting to buy up dividend stocks. That was my next focus, was becoming more defensive in the economy here. So we'll talk about that here and maybe towards the end here. So 5-day change for oil, down 11.55%. Over the last 3 months, it is down 36.03%. There's an oversupply in the market. Russia, OPEC, Syria, been pushing out too much oil out there. The economies are slowing down. They don't think they can use it all. There's an oversupply. Why? I'm waiting for the oil prices, the gas stations to fall. Right now, I'm not going to bring up local oil prices, but I think we were over $3 a gallon. Now we're like at $2.50. Now we're at $2.30. So they are starting to kind of trickle down. So I'm hoping to see that fall a little bit more. The dollar did get slightly stronger here towards the end of the week. It was at the lowest point there on Thursday, around 96.20. Before coming up. Now, a couple weeks ago, we were at 98, then we're at 97. So, weaker dollar should mean that the stock market should be being more positive, but stock market has too much stuff weighing it down besides government shutdown now that took place, tariffs, trade war, the rising rates, insider trading. So, we have Walmart, Apple, and a few others that they sold off their shares before this whole downturn here in October and November. So there's a couple articles out there on that. Gold slightly higher here, 1.42%. There was an article, so silver as well, up 0.29. Gold is better. If you're going to be investing in any sort of, if you want to keep your equity, your wealth, don't go for silver. Silver is nice. I have silver, but it's more for fun. I don't hold a lot of silver. It's just sort of like a fun thing. I like to just hold bars and such. But silver is used in too many commodities. It's used in too much, products, and it's fluctuated by the market. Gold, it doesn't have too many uses besides holding its value. So if you're looking to buy and hold gold, I watched another YouTuber out there kind of going over gold, and his take was, don't see. He's opposite of me. He said buy the paper bonds, buy the paper, versus going out there and buying it from the store. Because when you buy it from the store, you're going to be overbuying the price, and then you're going to be holding on to an item that you have to physically put somewhere within a safe or in the bank, and then when you go back to sell it, you're not going to get the full price that you're going to be able to sell it at. They're going to be taking some sort of a skim off the top. So he said that his focus was invested in gold. Now, another one that he had recommended is not ticker symbol GLD, but it is ticker symbol BAR. This is bar. So let's go ahead and flip over. It's trading near the exact same price, but if you actually look at this one as the expense ratios, bar is a lower expense ratio than gold. They both have the same volatility. They both have about the same price. Only your expense ratio on bar is much lower than it is on gold. Now, bonds also up here slightly, 0.38%. I'm not going to be investing in bonds. I don't care for bonds. Bonds don't raise their dividend. Bonds, you still lose value. So if you put $10,000 into your account thinking you're going to be safe in a bond fund, you lost 3.15%. That's $315 you would have lost out of $10,000. Sure, you have had a yield of around 2%, but they also have an expense ratio of 0.44%. So you'd be making a little over $200 in dividends. You would have lost $315 of equity, and then you would have had to pay taxes on those dividends that you would have received anyways from the bonds. And bonds don't raise their dividend. They don't go out there like Johnson & Johnson, Procter & Gamble, ADP, and just raise their dividend year after year. You're kind of just stuck there. And yeah, if you're going to go out there and you're just trying to find a non-risky area where you can stash your money in a high yield savings account. I use Marcus. I have a couple $1,000 sitting in Marcus, making me 2.15% every year. It's making me $30 to $40 every month just off the interest that's being compounded there month after month. I don't care if it's not invested. This is just rainy day fun. It makes my wife happy that we have money in the account that is available should we have any sort of emergencies or situations where we need to kind of dig into some cash that's available. It's just sitting there, not to be used in any sort of activities as far as investing. It's not in the business funds. It's not in the stock market. It's just off to its own little corner on timeout. So bonds right now are very low. So there's only like I want to say there's a difference of 0.07 to like 0.13% off the 2-year and the 10-year. I don't have the 2-year here. I know I was looking at it earlier where we're not quite inverted, but we're getting to that point now where we're actually going to be doing a complete inversion. So with the Fed rate, I was expecting the 10-year to kind of bounce up higher, but it has not. We are currently sitting at a 10-year yield of 2.79%. Look at this. 3-month one is at 2.33 and the 10-year is at 2.79. Why would you want to have your money locked in a 10-year treasury bond at making you 10.79% when you can just lock it in for 3 months and get a 2.33% yield right there? So, you should be getting 3.54% yield off these longer term funds, longer term bonds, but instead you're getting the difference there is getting shorter and shorter. So they did raise rates again here. So prime rate no longer 5.25. Prime rate is 5.5. I work at a credit union. We raised all of our rates last week. We raised all of our products from our auto loans. What are they? We had a couple products out there. I know we raised them anyways. So we haven't raised our mortgages, which is something we're going to be doing in the future. But I know I just locked in my rate is 5. This is an investment property, so it's not a normal loan. I can go out right now. I got a piece of paper I got in the mail that I can go out and get like a 3.75% loan right now for my VA, but I already have a 3% loan on my current home. But my investment property, I got locked in at 5.625%. So because it is an investment home, you do have to leave higher equity. You have to leave like 20-25% of your cash in the property or just equity, and you do have a higher yield interest rate than you would on a standard home. Okay, so if you guys do want to stick around, we're going to go ahead and jump over to M1 Finance now. So right now, year to date, we started this portfolio back in January 8th, 2018. We ran this portfolio down 12% initially. We lost I deposited $5,500 in my wife's Roth IRA, and it had dropped to $5,000 in just a few weeks. So there, what was our initial? There we go. We had lost, yeah, a little over 10%, a little over 9% there, just within the few weeks there as we were starting out this portfolio. Now, during the year, the stock market did climb. The portfolio was positive by, what, 7, 8% during the year. I wasn't investing as much capital at that time. Now, when the market started falling back in October 2018, that's when I really started to pump the equity here within the portfolio. I like a falling market because I did not design my wife's Roth IRA to be equity based. Equity is just money that you have. How would you like to just hire somebody for $100? This is all you're going to give them. It's a one-time thing. You pay them $100, and every year they go out there. You've already paid them their $100. They're going to go out. They're going to work for you. They're going to make you $3 a year, regardless of what you do going forward. You've already paid them $100. You got them working for you. That's the way I designed my wife's Roth IRA. So every dollar, every $100, every $1,000, it's out there working for me, making dividends. Now, currently, this portfolio is making roughly $370 in dividends, somewhere around there. I'm going to go ahead and pull it up on my other spreadsheet here and throw it in here. So currently, this isn't currently live data right now as far as where we're currently sitting at. I always update it at the end of the month. So currently we're looking at around $368.46 of dividends getting paid out in the account in 2019. Now that's only the starting point. Back when I started this portfolio back in February, January, her portfolio was destined, estimated to make $179.23 of dividends. But we're now at $188.84 of dividends. Now, 2019, we're going to be sitting at $368 of dividends. We're probably going to end up roughly making 450 dividends in 2019. Now, if the stock market does continue to fall, I'm able to buy back more shares with my dividends at a discounted price, meaning that my current yield here and my new buying yield. So these new buying yields here, I'm able to buy SO, where my current yield is 2.12. If I bought that stock right now, I'm getting a starting yield of 5.32%. So I'm going to continue to increase my average yield. My average yield sits right around 3.42%, but it's just going to kind of continue going forward. So let's see here. I don't know where the detail would be. I believe I can just share this and kind of copy it and move it into here. And this is going to show me my yield. So yeah, this current portfolio yield sits at 3.61. So it is going to be generating me some cash flow kind of going forward. Those dividends are going to be able to reinvest into themselves, buying back more shares, increasing my total dividend payout for 2019. And those dividends will work for me as well, working to buy back more shares. Plus, as these companies continue to raise their dividend, that's going to be giving me more buying power. And of course, we're going to be adding $115 every week, or I may end up breaking that down to a little over 100 by 5. That's 20 some dollars per day. I may end up deciding to schedule every day deposits of a little over $20 for 2019. That way I'm averaging into the market every single day. If I get paid out a dividend, that dividend is getting reinvested back into the market on that same day it was paid out. So I may transition that portfolio that way going forward. So we will talk more about this as I make my plan for 2018. We're going to go over the video here very shortly. But either way, am I worried that I'm down 12.19%? No, I don't really care. The equity has lost something, but again, I'm not planning on selling any of these companies. This is just sort of a dividend income portfolio. So right now, I'm down $973, but that's just paper money that I've lost. I haven't truly lost anything because I haven't sold it. These dividends will continue to work for me. These little helpers and workers that I've kind of hired along for, I gave them $100 and they're giving me back $3 every year going forward over the next X amount of time. Now, if I do sell them, I do have a couple positions here that I've actually been positive on, but these are just there and they're kind of working, but not too worried. Anyways, that is all I wanted to cover in today's video. If you guys did enjoy the weekly recap, let me know in the comment section below. Hit that subscribe button if you are not yet a subscriber. hit that thumbs up button below if you did like the video. Leave me a comment. Are you worried about the stock market kind of going forward? Are you happy that it's falling? I'm excited that the stock market's falling. That just gives me my dividends much more buying power right now than they currently have been having during 2018. So thank you all for tuning in. I will see you next time. Have a great day. Bye.